Hi, my name is Steven Ocheng. I'm a trainer from Somo, Africa, and today we want to talk about financial feasibility. So what is financial feasibility? Financial feasibility is the process of testing your business idea if it's likely to be successful or not. Financial feasibility has four main parts. The first part is pricing, second part is revenue, third part is cost, and the last part is feasibility test. Part 1. Set the price of your product or service. In this case, decide what you're going to charge your customers for the product or service that you're offering. It's also very important to know what your competitors are charging for the product or the services that you offer as a business. After deciding on your price, we'll go to the second part, which is revenue. The most important question we're asking ourselves here is, how many products or services can you sell in a month? In the case of Sarah's business, she is planning to sell 1,000 chapatis at the end of the month. So how much in terms of revenue will she be able to generate out of the sale of 1,000 chapatis? In that case, we'll now come to our revenue table and fill it up. Product in this case is chapati. The number of units that she's expecting to sell at the end of the month is 1,000. Price per unit is 20 shillings. The amount of revenue Sarah is generating out of sale of 1,000 chapatis is 20,000 shillings. That means her total monthly revenue will be 20,000 shillings. Part 3. Expenses. The first part we're going to look at is fixed costs. And fixed cost is what you need to spend each month regardless of the number of units produced. In the case of Sarah's business, her fixed costs are rent and salary. Sarah pays herself a salary of 3,000 shillings at the end of the month. She incurs a rental charge of 1,000 shillings. So I'll put salary. The number of units in this case is 1, and the price per unit is 3,000. The next fixed cost is rent. The number of units is 1. That means 1 space. The price per unit is 1,000 shillings. That brings the total fixed cost to 4,000 shillings. Sarah incurs 4,000 shillings as her fixed cost at the end of each month. After looking at fixed cost, we'll now go to the second part, which is variable cost. And variable cost is what you need to spend for each unit you produce. Sarah will need flour. She'll also need water. She'll also need salt. And lastly, cooking oil. These are the 4 ingredients that Sarah will use to make her chapati. In the case of flour, she will use 2 kilograms of flour. She'll also use 5 liters of water. She'll also use 2 tablespoons of salt. And lastly, she'll use 2 liters of cooking oil. 1 kilogram of flour goes for 60 shillings. 1 liter of water goes for 1 shilling. 1 tablespoon of salt goes for 1 shilling. A liter of cooking oil goes for 160 shillings. For Sarah to make 50 chapatis in a day, she is incurring 465 shillings. That means the number of units produced in a day is 50 chapatis. The variable cost per unit produced is therefore 9 shillings. The number of units produced per month is 1,000. Her total variable cost at the end of the month is therefore 9,300 shillings. After variable cost, the last part we're going to look at under expenses is capital. And capital is essentially what you need to spend upfront. In the case of Sarah's business, she will need 1. gas cooker, she'll also need rolling stick, she'll also need rolling pan, she'll also need a basin, she'll also need a spoon, she'll also need a cooking pan. These are capital expenses for Sarah's business. After filling in the capital expenses, the next thing we're going to fill is the number of units. In this case, she will need one gas cooker, which goes for 13,000 shillings. The rolling stick will be one piece, which goes for 200 shillings. The rolling pan will also be one piece, which goes for 500 shillings. A basin will be two pieces, which each going for 250 shillings. A spoon will be one piece, each going for 10 shillings. A cooking pan will be one piece, each going for 700 shillings. Her total capital investment will therefore be 14,910 shillings. After filling in the expenses, we'll now be going to the last part, which is part 4, feasibility test. And feasibility test is all about determining if your business can generate more revenue than cost. The first part is, how much revenue will I generate at the end of each month? In the case of Sarah's business, her total revenue at the end of each month is 20,000 shillings. Her total cost is 13,300 shillings. Her monthly profit is therefore 6,700 shillings. The second part of feasibility test is, how long will it take to pay back my initial investment? In the case of Sarah, her total capital investment is 14,910 shillings. Her monthly profit is 6,700 shillings. That means her payback period will be 2 months. That is, the total capital investment of 14,900 shillings divided by a monthly profit of 6,700 shillings. That gives you 2 months. We've come to the end of the lesson. Thank you for watching. If you have any questions, please leave them on the comment below section. Be sure to share this video, like and subscribe to our YouTube channel.